Welcome to Crescat's Market Call, featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please read through our important disclosures being shown now. These and additional disclosures regarding the risks involved in the type of investments we will be discussing, as well as the fund's performance, can be found on Crescat's YouTube channel or on our website using the QR codes on the slides. The type of investments discussed on these videos can carry significant risks, including risk of loss. The videos are intended to be general discussions of macro investment themes, the mining industry, and news with respect to the companies in our activist metals portfolio, and are not intended to be investment advice or an offer of investment advice or services. Crescat's managed funds only accept accredited investors, and the discussion in these videos has been prepared with that level of audience sophistication in mind. Any forward-looking statements may or may not come to fruition. If you enjoy our videos, please click on the like button and make sure you are subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on X for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to our head of investor relations, Merrick Iwahashi. His contact information is on the screen now and can also be found on our website at crescat.net. Welcome, everyone. We've got an exciting show for you today. We've got myself and Nathaniel. We'll be doing macro. I will be going through an extensive presentation that is going to be fast because there's a lot of information to get through with a lot of new insights, analysis, commentary from Bill Pearson, Crescat's geologic and technical advisor, and then we will have a very special segment at the end with Lars Theill. Lars is Crescat's Biotech analyst about to become a portfolio manager here. And we have a very special presentation from him on the Biotech fund that Crescat will be launching in the coming weeks, a little preview of that. So let's get started. I put this chart out on Twitter, and it got some pretty good traction over last weekend. This was a chart we had out in our letter a few months ago, but I've updated it. Why? Because all or four of the five hyperscalers reported earnings last week. And when you look at the forward free cash flow estimates now for these, for all five of the biggest hyperscalers across the Wall Street analysts, the forward 4-quarter analyst free cash flow estimates have plunged basically to zero. So the collective free cash flow from some of the biggest free cash flow generating companies in the S&P 500 historically that have been driving the performance of the S&P 500, frankly. And as you can see, look at the correlation between that red line and the white line, which is the aggregate forward 4-quarter free cash flow. It used to drive the whole S&P 500. Look how tightly correlated it is. Now look at this divergence, this shark jaws that we have. I think we're in a bubble, and this really illustrates the extent of that bubble. Not only that, it's a catalyst for the unwinding. Not unlike we had at the peak of the tech bubble with the telecom spending boom at the peak of the internet bubble in 2000. It's the same dang thing. Here it is right in our faces. Let's go on to the next. This was in our last letter showing the Warren Buffett indicator. Paul Tudor Jones has talked about this indicator recently. It is at historic all-time highs. We put this chart out a few weeks ago, or a week ago, but look at it. We're 220% total U.S. stock market value to GDP. It's the highest ever. It's higher than we were in 1929. It's higher than we were at the Nifty 50 bubble in 1972. Higher than the internet bubble in 2000. Above the this is this is historic. But what's the catalyst for its unwinding? That's the question. I think there are three catalysts. It's inflation that's out there today that is unstoppable. It's that capex overspending that we talked about. That capex overspending is resulting in earnings that are extremely inflated for all of those companies, because they're assuming that they're going to get the same return on investment that they've had in the past from this new record investment and this change in business model. And it's just like at the internet bubble in 2000, it's not guaranteed at all. So the earnings estimates are just highly inflated out there. I'm not going to dwell on that too much, but let's go on to my final macro chart. People think that the market just goes up, up, up forever. It does not. Let me finish. The three catalysts are the inflation, it's the capex bubble, and it's the hawkish new Fed share that's coming in. Those are the three catalysts for the market to come down here and eventually go into a bear market, I think. But this is showing now that we do have bear markets historically. This is all of the time historically going back to the 1920s, that the S&P 500, when it first came into existence, has been in a drawdown from an all-time high. It shows the extent of those drawdowns. 86% into 1932 after the 1929 peak, 48% in 73, 74, 49% during the tech bust, 57% during the global financial crisis. And all that red shaded area is the time that we spend just getting back to new all-time highs. Okay, so yeah, this chart was done a couple of weeks ago, and we've gone even higher. We're still at all-time highs. I'm going to turn it over now to Nathaniel to continue the macro pre-zone.
Thanks, Kevin. So right here, we're looking at some different baskets. Most of these are Goldman Sachs ones and 1 month returns over the past month. And then the blue is highlighted the S&P 500. And what we're seeing here is kind of some of the more, I'd say, speculative sections of the market, specifically focused in tech, have been really ripping. We're seeing quantum computing up 34%, most shorted tech, non-profitable tech. This is kind of leading into the market is in a euphoric state right now and just ripping in these kind of high growth, high risk areas. Let's go on to the next chart. Feeding into the euphoria, we're looking at the NASDAQ 100 above its 50-day moving average. And right now we're about sitting at 13%, maybe a little bit higher above its 50-day. Going back, we haven't seen this happen a whole lot. Other times we have seen it have been closer to market bottoms, right? Back in 2009 and in 2020. In fact, the last time we saw NASDAQ this high above its 50-day moving average and pushing to all-time highs was, take a guess, March of 2000. Just again, further showing the kind of euphoric state we're in right now. And quite frankly, we believe this is not something that can be continued for much longer. Let's go to the next chart. We've had a slew of economic data coming out today. That's a little small, Trevor. Can you make that full screen, please? Second, thank you. So this is non-farm payrolls. Big surprise to the upside, actually. Came in at 115, expecting 160, or expecting 65. But one thing I want to remind everyone is we should look at the composite of these jobs. So this is a breakdown here showing what sectors have been adding jobs, what have been losing jobs. And you can see that we're still losing jobs in infotech, we're still losing jobs in financial services, we're losing jobs in manufacturing. So even though there's that headline beat, what's going on under the surface could be, hold on one second, there we go, telling a slightly different story, where most of the job growth has been driven by education and healthcare services right now. Let's go on to the next slide. What else do we have today? Consumer sentiment from the University of Michigan that's plunging to an all-time low. I don't know if it's exactly an all-time low, but it's very, very close, coming in at 48.2. And we're seeing this disconnect in the markets right here. Sentiment is very, very low, but the employment numbers are looking good and the market is performing. I just don't. There is some kind of disconnect going on here. Let's go on to the next slide. Further in this is from Whirlpool, that put out earnings on, I think it was 2 days ago, and they got absolutely crushed on it. And what they're citing is this is because of the Iraq war. They're saying, line in there, let's see, where's the exact quote? I can't find it, but they said they haven't seen things this bad since the global financial crisis. Consumer sentiment is low. People aren't buying appliances. People aren't buying houses. And they're trying to blame it on the Iraq war. Well, yes, the Iraq war can probably, be attributed to some of it, but it's not the full cause. Again, going back, we saw consumer sentiment was falling before. And again, just showing that the broader economy, the consumer, is not as healthy as we necessarily think it might be. Let's go on to the next slide. And just again, this is looking at household employment when it drops 4 months in a row. Every time it's happened, except for once in 1968, we've been in some kind of recession. So we're having these recession signs flashing here and there, and yet market's at an all-time high. There's just this disconnect going on.
Okay, Trevor, let's go on to the next. So I'm going to go. Thanks, Nathaniel. He was saying Iraq war. We all remember the Iraq.
Oh, Iraq. Was I saying Iraq? I meant Iran. Sorry.
We meant Iran. Look, what we're going to do here today is new. So get ready. And it's a little bit experimental, so bear with us. But I think you're going to like it, because the goal here is to convey a lot more information to our investors, to prospective investors out there, and the public in general, regarding our mining portfolio. Our activist metals portfolio is the largest theme across all of Crescat's funds. It was the theme that was the driver of our phenomenal year that we had last year. Crescat had 5 of the top 16 performing hedge funds in the world, largely because of this theme. We continued that performance in the first couple of months of this year, and then we had the Iran war break out, and we had this unusual pullback in gold and silver, which was not something that we saw during the Arab oil embargo back in the 1970s, and I don't think it's sustainable today. We think the big opportunity on the commodity front, on the inflation front, is still in the metals. That's why it remains our largest theme. It's our largest fund, the Crescat Precious Metals Fund, and the Institutional Precious Metals Fund that we have. By the way, we just renamed the Institutional Commodity Fund as the Institutional Precious Metals Fund to better reflect that fund's past and ongoing composition as the institutional version of our Precious Metals Fund, because the Precious Metals Fund itself, our largest fund, is closed to new U.S. investors because we reached our 100 investor limit. The Crescat Institutional Precious Metals Fund can now it can only take institutional clients, qualified purchasers, but it can take up to 2,000 U.S. investors. So anyway, look, the format today, we have new slides regarding each of our companies that have reported news over the past couple of weeks, and we have in-depth analysis from Bill Pearson, Crescat's new geologic and technical advisor, and Bill has extensive written analysis So I'm going to encourage you to go back and watch the replay of this presentation to soak in a lot of these slides, because I can only just touch on them. And we'll also be posting this whole slide presentation itself on our website. So Tectonic Metals, they just announced their new drill season. The plan for the new drill season, 40,000 meters of drilling. They're fully cashed up with $88 million from their recent capital raise, Canadian, and I think it's going to be a phenomenal drill season ahead. Some of the highlights to point out about Tectonic. Something else to point out on these slides. You're going to see this is one of our largest positions at Crescat, our second largest position after San Cristobal, and you can see there up at the top, we own 22% of this company on a partially diluted basis, and we have this is 8% of our firm assets at Crescat that it represents. Partially diluted means including the warrants. What percentage of this company do we own, including warrants, if we were to exercise those? So, look, this is only a $226 million market cap company. Our geologic estimates we're going to be talking about on these slides. We've got an $8 million target. Our gross target is much higher than that, but that based upon the drilling to date, we're confident that they can produce at least 8 million ounces of gold, an 8 million ounce target on the left there. If you just look at that 8 million ounce target, that's $37.5 billion worth of gold in the ground at today's metal prices. Of course, these companies, the exploration companies especially, trade at a small fraction of that gross metal value in the ground, because ultimately, that has to be turned into a mine. It's going to cost money. We have an expected profitability percentile that is part of our geologic estimates for these companies, and that you can read it down there in the footnotes. But it's based upon the grade and the expected projected recoveries, the projected capex, the projected operating costs, and we do not invest in anything that's going to be in the lower quartile or even the lower half of expected profitability percentile. We want to invest in things that can become mines, that will be profitable mines, and that's what we're all about. Let's go on to the next here. So this is a map of Chicken Mountain and the drilling there to date. 100% drill success. 191 of 191 holes have intersected gold mineralization. This is just the Chicken Mountain, where they're going to focus on the initial resource and the PEA and the project that they will likely move forward into production. This is one of the most exciting stories out there and has some of the biggest growth potential among our portfolio, and that's why it's our second largest position across the firm. We think there's so much growth ahead and further resource to identify. I'll just give you, you can go on to the next slide, and I'll just say some of the highlights from Bill's commentary. Again, we're just looking at a plan view, a top-down view of this Chicken Mountain to Alpha Bolt region with over 3 kilometers of strike, room to grow in all directions. The mineralization, the grade that they're hitting here is really exciting. This project is located just 40 kilometers northeast of Donlin Creek, of Donlin Gold, a project that's moving forward towards construction right now. They have great infrastructure. A fully permitted natural gas pipeline is now in the process of being built, as well as road access. There's road access to Chicken Mountain. They have a 4,100-foot Hercules cargo plane airstrip. Overall, this is a 20-plus kilometer volcanic plutonic complex with at least 6 kilometer plus scale intrusion targets. This is just one of those targets that we're looking at here, called Chicken Mountain. It's their flagship project. It's a reduced, this whole complex is a reduced intrusion related gold system model with excellent upside exploration potential. And it's, if you look at the comparable scale of the project is similar to Donlin Creek, where they have 39 million ounces of gold. And the main objective of this year's drilling program is to work towards a 43-101 compliant mineral resource estimate, and ultimately a PEA that will get this that will make this eligible for a Fast 41, fast tracking status under the U.S. federal mining regulations that Trump has put into place. Anyway, we're really excited about this. Let's go on to the next. So you can read this one at your leisure when you go back. It's just more extensive analysis from Bill Pearson, our PhD geologic and technical advisor. And I'm not going to dwell on this slide for now. Let's keep going. Eloro Resources. So Bill, of course, was involved in the discovery of Eloro along with Oswaldo. It is one of the biggest new silver discoveries on the planet right now. Similar to our San Cristobal, where Crescat is also the largest shareholder. Quentin's, who is chairman, CEO of San Cristobal, and is now so fully immersed in that we had to hire Bill to supplement Quentin. And Quentin remains a director of many of our companies, but his full-time job is San Cristobal, so he doesn't have the time to do all this in-depth analysis that Bill is now adding to the picture for us. But the Bill was as a PhD geologist, and he was one of the discoverers of Eloro, and we're the largest shareholders. It's like our third largest position at the company. At Crescat, we own we've got a 5% position across our whole firm NAV, and we own 16.2% of the company on a partially diluted basis. Crescat funds are the largest shareholder here. It's one of the two biggest silver discoveries in the world over the last several hundred years that we have in our portfolio. We're the largest shareholders of both. This one is you can see commentary in here. They are cashed up for a 40,000 meter drill program right now. They need to do the infill drilling to show that the economic viability of this mining project is there. The gross tonnage is enormous, but they need closer drill spacing to really show the true robust economics of this project. 3 drill rigs we expect to be running here over the course of this next drill phase. Let's go on to the next. This is showing the east-west cross section, 1,400 meters of the Iska project that the recently announced MRE is based upon. And you can see that high-grade section there, the high-grade silver section in red. This is basically an outline of what the pit will look like here. And the updated MRE outlines an indicated mineral resource of 85 million tons, grading 40 grams per ton silver, containing 109.5 million ounces of silver. Silver alone. There's also zinc, high-grade zinc and lead. This is a polymetallic system. It's a silver dominant system. There's a 10 porphyry beneath all of this as well. So the inferred mineral resource on top of the indicated is 945 million tons, grading 8.5 grams, containing an additional 248.6 million ounces of silver, along with the zinc and the lead. Overall, this resource is something around 1.25 billion ounces of silver equivalent. Okay, this is an enormous system that has so much room to grow through further definition drilling as they work towards a PEA and a PFS, which we believe are coming in the near future. This is one of the largest silver and tin polymetallic resources in Bolivia and in Latin America. What's Bolivia known for? It's known for Cerro Rico de Potosí, which is the largest silver discovery in history. It's been producing silver for 500 years. This is in the same Bolivian 10 belt as Cerro Rico de Potosí, this deposit here. And Cerro Rico de Potosí is what created the wealth of the Spanish Empire in the 1500s. We have two of these Cerro Rico de Potosí like major silver discoveries in our portfolio today. San Cristobal and Eloro Crescat funds are the largest shareholders. Let's keep going here. Some other bullet points from on Eloro here, and two maps that you can look at just to get a sense of the overall scale here. There's targeted step out drilling with 50-meter spacing going on now within the high grade core section, and with further potential to expand the indicated resource. We've got testing down dip and strike length of known higher grade silver and 10 polymetallic shoots, which remain open laterally and vertically. The company is following up on the successful 24 and 25 drill program that extended the mineralized envelope down dip and along strike of approximately 1.4 kilometers. Major drilling. The drill contractor is in the process of mobilizing 2 diamond drill rigs right now to this project here at Iska, with a third drill expected to be added in the next 3 months. Let's keep going. SilverBow Mining. SilverBow has been one of our longtime activist projects on the private side of the portfolio. SilverBow just went public last week, and we own 8.7% of this company on a partially diluted basis. It's a 4.6% position. SilverBow is one of the among the most exciting projects and companies in our portfolio. That's why it's one of our largest positions, and we added money in the IPO. It's 305. This one went public in the U.S. Cantor Fitzgerald just took them public. It's 305 million market cap, U.S. market cap company with $65 million U.S. in cash in the bank right now to fund 2 years worth of drilling. This company is fully cashed up to go in and open up the. They're going to be opening up the tunnels of the old Anaconda mine. So what SilverBow owns is basically 70% of the historic Butte, Montana mining district. This is one of the highest. This district has some of the highest. It's not only silver, but it's some of the highest grade copper in the world. It's like down at depth. The copper grades at 2,000 feet down, I believe it's 2,000 feet, are 5% copper. The USGS in a report back in 1998 said that this is the single largest copper and undeveloped copper and silver deposit in the United States. There is so much room to grow. If you listen to Travis, the CEO, talk about it, he says this potential resource, they have an actual resource currently. It's 6.5 million ounces on a gold equivalent basis. This is primary silver, though, keep in mind. But this overall resource has the potential to grow in multiples. You listen to Travis, it's not in increments, it's in multiples. This is an enormous district. SilverBow has 70% of this historic district, and they're going to have 4 drills operating. And there's a lot of good news, we think, still to come here. And so it's not just a silver story, it's a copper story too. It's an exploration story, a huge room for growth and upside here. Anyway, let's, by the way, Travis, the CEO, rang the bell on the New York Stock Exchange today. We're going to be redistributing a clip of him talking to Ashley at the New York Stock Exchange, a reporter there for NYSE TV. We will be redistributing that I got to keep cranking here because I got too many slides. Let's go on to the next. You can see, some of the information on the company's website. They're still in a 25-day post-IPO quiet period, so they will not be updating their full presentation until for another few weeks. But you can see some of the information here. Historically, Butte, Montana is reported to have produced 702 million ounces of silver, 2.5 million ounces of gold, 11.2 million tons of copper, 2.2 million tons of zinc, and on and on. Manganese, molybdenum. This is a huge, very rich mining district with a rich history. Anaconda Copper used to operate this mine. And anyway, some other comments from Bill here on this. Butte's an exceptional example of a porphyry high-grade vein hybrid system with exceptional vertical zoning of silver, manganese, and lead, silver, zinc, and lead veins, and copper rich down deep. As I was saying, this was established with an exploration permit in place and an underground decline permit amendment in progress. They're going to be opening up the historic tunnels here and doing a lot of work over the next 2 years. Stay tuned. A lot of good news to come. Let's keep going. More information that you can read at your leisure. Analysis and quotes from Bill here. So let's go on to the next. Sitka Gold, another one of our largest positions at Crescat across our funds. And when you look at the size of our a company that has a large position, it's a reflection of a couple of things. Yes, it's probably had a lot of appreciation already, and we likely have gotten in cheaper, but it remains one of our largest positions because we believe it still has tremendous upside potential ahead based upon our geologic modeling. And Sitka is onto this Snowline-like, tectonic-like reduced intrusion style gold system with multiple intrusive targets. I mean, they just keep hitting phenomenal mineralization. They've just reported in their news release that they have a 60,000 meter diamond drill program underway, with multiple occurrences of visible gold reported in the holes completed so far already at both Blackjack and Rosgobble. Rosgobble, they've also intersected tungsten that they believe is going to be economically additive, and so does Bill to this project. There's 4 diamond drill rigs currently running on the property, 2 additional rigs anticipated to mobilize in the coming weeks. So when we say expected number of drills, and this is something that Quentin had originally pioneered for us, and we're very proud of, we're proud of the fact that across the portfolio at Crescat, we have more drills operating across our portfolio companies, more greenfield drills than all the major mining companies combined. We're not afraid to invest in exploration projects. We think that's where the big upside is in the current supply and demand picture that we have for precious and critical metals today, and so we are able to get money to the companies to do the drilling to create these new deposits, the metals that the world needs. So Sitka, we own 8.9%, partially diluted across this company, and it's 4.3% position. Based upon our geologic estimates, we think they've identified $56 billion worth of gold already. I mean, this is why we love investing in exploration, because you can come in to a small cap company. This one's 465 million Canadian market cap now. When we originally came in here, it was probably less than a 50 million market cap. But we think there is still enormous upside based upon our geologic estimates. That's why it remains one of our largest positions and one we've been adding to over the past several months. Let's go on to the next. Their RC Gold project. This is a map of it. It's in the Yukon. Look, I'm not going to be able to hit up all these points. I got too many slides, so I'm going to ask you all to come back and review these. It's got a lot of bills, commentary, and geologic analysis in here, along with maps from the company. But we're going to have to keep cranking on to the next. In another view of their RC Gold project, you can see all these multiple intrusive targets that they have, including many that they've already drilled aggressively. This company already has a 5 million ounce gold resource, but so much room to grow this resource, especially with all of the drilling that they're going to be doing, which they are fully cashed up to do right now. Let's keep going. Again, looking now at a cross-sectional view across the different their different targets, and what you can see how much they've drilled already, but there's still so much drilling to go. 60,000 meter program now underway. That's enormous. Let's go on to the next. Again, a lot of these slides will have some of the deeper commentary from Bill. If you want to come back and read them at your leisure. Let's keep going. Barksdale Resources. Wow, they had an incredible new discovery recently that they just announced a week or so ago. And you look at the stock and see how the market reacted to it. It was unexpected. The bigger target at Barksdale here was the deeper silver zinc CRD system. That's the extension of the Theill deposit. The Theill deposit's right next door, and it's being developed right now it's about to go into production, I believe, by South 32, and this is in Arizona. So we've been chasing the silver CRD here, and got really close with the latest deep hole that was drilled. But the main purpose of this recent drill program was to complete the earn-in that the company has with Great Basin Minerals. At Great Basin Metals, the company owns 51% of the project, but additional drilling will get them to a 65% ownership. And so the area that they drilled recently was going after some of the copper showings near surface above the Sunnyside porphyry. But we believe once the recent drilling is completed, they will go up to their 65%. But it was an unexpected amount of high grade copper that they hit in these holes, it's basically showing that that what they thought was originally not a very well mineralized copper porphyry system, even though it was the Sunnyside porphyry, is the system that's driving that whole CRD and the whole Theill deposit that's going into production right now. The core, it's the heat engine for that. But now with this latest drilling, they're actually showing that the Sunnyside porphyry, the same thing as the old timers thought back in the day, is actually a highly enriched copper porphyry system. So there is a new copper discovery at Barksdale, and it's very exciting. Let's go on to the next. So it was May 4th. They released the results from 4 RC drill holes, and they hit broad zones of shallow, high-grade copper, zinc, and silver mineralization within a chalcocite zone of the Sunnyside monzonite porphyry. This is kind of a top-down view of this area, and you can see in the gray, that's the South 32 claims of the Hermosa project and the Theill deposit that's about to go into production. And we have what we not only believe is the extension of that Theill deposit down deep, the silver CRD, but we also have now a highly enriched copper discovery that's the main porphyry engine of this whole metals, this whole mineralized system here. So 0.5, some highlight holes here, 0.5% copper over 339 meters. And that's hole number 2. 0.9% copper over 61 meters, 93% over 61 meters, 0.3% over 451, 0.6% over 53. These were really surprising high-grade copper results. There's a lot more drilling that needs to be done here to flesh out this this copper porphyry that we have, and it's very exciting. Let's go on to the next. This is showing the this is from the company's own presentation, showing these chalcocite targets. Chalcocite is a highly enriched copper mineral, and you can see the historic Asarco. Asarco historically drilled this. I don't know how many years ago. It was a long time ago, and they abandoned it because they thought they had a thesis that this was high grade copper, but they abandoned the project, and it's only now that Barksdale has discovered that this really is a high grade copper porphyry. Let's go on to the next. Again, another map that you can look at from the company's website. You can see the drill holes that they did in the upper left here recently that hit this copper, and that deep hole going down there into the guts of the porphyry. That's the big prize down there that they need to further test. But those are historic. That's a historic hole that I believe is down there, showing 415 meters of 0.36 copper. I don't believe that was part of the current drill program. The current drill program was all those short holes up there, but they've identified much higher grade than the prior drilling had seen. So exciting days ahead, we believe, for Barksdale. Let's go on to the next. You can read more about this at your leisure. More comments from Bill and analysis. Let's go on to the next. BCM Resources. So they're drilling. They have they've got a blind target, but it's a dang good one. It's one that was always one of Quentin's favorites, and they've hit some exciting mineralization in the drill holes. We're waiting for assays still, but they had made a discovery here back with 155 meters of 0.66 copper, and they need to just continue to drill and follow up on this thing. We got 17.1% of this company on a partially diluted basis. It's a 1.3% position. Stock has been performing pretty good recently, based upon some of the analysis of the drill core. They do have drill core awaiting assays. 68 million Canadian market cap. This is one that we currently have it as a 5 million gold equivalent target. Is copper. It's another Bingham Canyon style copper target on that same basic trend. This one is in Utah, in the Great Basin. Let's go on to the next. And you can see the they're focused on exploring this Thompson Knolls. It's their flagship project. It's a copper, gold, and silver and molybdenum porphyry target. It's located in the Great Basin of western Utah. It's about 200 kilometers southwest of Kennecott Copper's Bingham Canyon mine. Bingham Canyon, one of the biggest copper mines historically in the U.S., and these guys are looking for another Bingham Canyon. Let's go on to the next. Kingfisher Metals. This is one that Bill was particularly excited about when he started, reading about their latest drill results and their target. We own 5.7% of this company on a partially diluted basis. It's a 1.1% position. The stock has had a pretty big run over the past several months based upon the drill hole that was, I don't know if it's a discovery hole or not. The company's calling it a discovery hole. It's definitely a strong indication. Bill thinks it's an indication that they're on the edge of a much bigger discovery, it's 168 million Canadian market cap. They just did a capital raise. They have $28 million roughly of cash on hand Canadian, and they're in the midst of a 15,000 meter drill program. It's going to start next month, a new 15,000 meter drill program. Anyway, let's go on to the next. So here's from the company's own website. It's in the heart of the Golden Triangle with good road access. It's on a highway. That's why they call it the Highway 37 project. They have a lot of land. Dustin, the CEO and the lead geologist here, has done a lot of work acquiring some prime ground in BC and inside the Golden Triangle, British Columbia, and so it's one of the most well endowed mining camps in the world, hosting over 310 million ounces of gold, 2,000 million ounces. I'm sorry, 2 billion ounces of silver and 114 billion pounds of copper. Anyway, I don't have a lot of time to come back and review these slides at your leisure. Let's go on to the next. It's showing another map from the company's website, and there's a 12-kilometer long mineral system here that is on their ground, and you can see a lot of the historic highlights from some of the drill holes here in the past. Anyway, I'm not going to dwell on this one because I want to get on to the next slide where Bill was really focused on this slide because it's showing, based upon the company's geophysical interpretation and that latest drill hole that they hit, what they potentially have here. And the big prize is that interpreted porphyry complex, and that comes from the company's own geophysical interpretation. But the actual drill hole from a few months ago that they put out, that drill hole number 11, that has basically tagged the edge of this porphyry system. That was 425 meters of 0.4% copper equivalent. As they do more drilling and get into the guts of this thing, we think those grades can be going up substantially. But what's exciting is there, if you look up at the top with those historical drill holes, there's this epithermal gold, layer above it. These are historic holes, and just a good indication that you have this fully intact porphyry complex with the upper epithermal gold system there. There's a lot of potential with further drilling to really flesh this thing out, and that's why the stock has been going up. It's been going up on the good news of that drill hole and the potential to grow a much bigger resource here, with the gold at the top and the copper at the bottom. Let's go on to the next. Mogotes Metals. Now, I think Mogotes had an excellent first pass drill result that they just put out. This is a huge copper target, a huge copper gold system that's much like Theill. Theill is a joint venture between Lundin Mining and BHP, which is worth multi billions of dollars now and under development right now, between the Lundins and BHP. Mogotes has the ground to the due south with some of the same big porphyry targets, and this thing it's only 117 million Canadian market cap. They've got 39 million in cash on hand, and they're drilling. But they hit, actually, people thought the drill results were disappointing and the stock sold off. It was anything but disappointing, and I'm going to show you why. Let's go on to the next. This slide, well, it'll be the next slide that shows you why, but let's talk about some more highlights here. They're advancing their Philo Sur, copper, gold, and silver district scale exploration property, and it's in the Vicuña district. It's on the Argentine, Colombia, and Chile border, just like Philo, which is directly adjacent to it, and it covers 100,000 square kilometers of property. They have a big piece of ground on the eastern flank of the Andes Cordillera in the San Juan province of Argentina and extending into northern Chile. I'm going to skip to the next slide in the interest of time, just to again, more information here you can read at your leisure. But I think let's go back because I guess we didn't include the one slide that I wanted to include here. What you need to do is read Bill's analysis here, and what you need to understand is the drill holes were not disappointing at all on that first pass. They were phenomenal because they hit broad intercepts of gold that are even higher grade gold than the gold that at the Philo system that sits atop those big copper porphyry that they have discovered. So it really, as Quentin has always said, and Bill is now confirming, that this is a Philo type target, and it's only they're drilling at their primary target. These first drill results that they put out were only their second best target. They're drilling right now at their primary target, which is another one of these Philo porphyry targets, and we're just excited about what's to come here. The company's got all kinds of other great news, which you can go read about too. Other projects that they've acquired, and I think there's a lot of upside ahead at Mogotes. Let's go on to the next. Hannan Metals. Hannan is we got a 4.9% position, partially diluted here. It's a 0.4% position. It's only a 72 million Canadian market cap company, but they have a big target. And with their latest news release, they just reported that their Provisto project is an outcropping alkaline gold system project. They have 68 channel samples into this thing that have come back mineralized. It's 110 meters by 20 meters, and some of the channel samples are really high grade. Quentin has always been really excited about this project in the past, and Bill is now too. Every single channel sample is mineralized with no barren shoulder identified in any direction. Provisto Central is not a single vein. It's a substantial coherent body. That's Michael Hudson, CEO. He's a geologist. Anyway, let's go on to the next one here. You can kind of see the outline from the top-down view. This is it's a district scale gold exploration play. It's in Peru, which is a country known for large gold deposits. This is the first alkalic epithermal porphyry gold and copper system recognized in Peru. This type of deposit is relatively rare globally, but it's generally of very high value. Cripple Creek in the U.S. is the primary example of alkaline porphyry gold system, and it's produced some 30 million ounces of gold. So these things can be highly economic mines. The company's completed extensive baseline geologic and geochemical and geophysical work to outline a major mineralized belt, some 13 kilometers long. That's reported in their news release on May 4th. The latest high-grade channel samples that they have, 69 meters of 2.4 grams gold, including 26 meters of 5 grams gold. Rock chips as high as 6.7 grams have been reported. No drilling has been done to date, but permitting is in progress. And the north and central target zones are within 7 kilometers by 6 kilometers of gold and soil geochemical anomaly. This is a big alkalic gold target, and we're going to be excited to put more money into this company when they get ready to go drilling, when they get their permits. Let's go on to the next. Just showing Previsto, some highlights from the company's own website on this Previsto alkaline gold target. Let's keep going here. Cosa Resources. This is a company that we put money into recently in a private placement. Normally, we don't invest in uranium stocks. That is the primary metal here. But this management team has an incredible background. They were the management and geologic team here are credited with co-founding of both Next Gen and ISO Energy, as well as the discovery of the Phoenix, Gryphon, and Hurricane uranium deposits. They've been involved in 3 companies, 2 of which are multi-billion-dollar uranium exploration companies. And this Cosa Resources is in that same Athabasca region of mainly in northern Saskatchewan, bleeds into Alberta some, but this is the prime district for uranium, highest-grade uranium on the planet, next to some places in Russia probably, but it's Quentin historically has said, I'm not a big uranium fan, but he said this is one you can invest in. And it was after meeting with the geologic team, and they're on to a new discovery. The money that we put in has helped to identify a new discovery. Let's go on to the next. This is just showing, where they are in the proximity to Cigar Lake. Cigar Lake is the biggest uranium deposit now controlled by Cameco, one of the largest cap uranium miners out there. Anyway, I'm not going to dwell on this one. It's not a huge position for us, but we do have a significant stake in the company, and we're excited about the further upside here. Let's go on to the next. You can read more about it here. Let's keep going because there's been a lot of news recently. Kirkland Lake discoveries, and I don't know if we have the true if that's accurate, that we only own 0.1% of this one. I wish we had more. We put in a little bit of money into this company in their recent private placement, and maybe we don't own. I think we own a little bit more than that, so we'll have to update that slide. But it is a 1.3% position across our firm, and they've made some exceptionally good recent hits, some bona fide high grade gold discovery holes that they've put out from their recent drilling, and this is an exciting project in the Ontario region. I'm not going to dwell too much on it. You can read about it later. Let's go on to the next. This is from the company's website, as well as some bullet points from Bill that you can read at your leisure. They are on to a significant new gold discovery. Let's go on to the next, and more that you can read about on your own. Let's keep going. Orestone Mining. This is this company just put out some trench results that were pretty impressive. 72 meter trench with 37 meters, grading 0.78 grams think that's supposed to say gold. It says AI, but it's supposed to say AU. And 7.2 grams silver, 11 meters grading 0.58 grams within that. This is a project that we put money into so that they could drill their Francisca gold and silver project in the Salta province of Argentina. This is in northern Argentina, and we're excited about the potential here. This company will need to raise money to drill, but we own 19.9% of this company on a partially diluted basis. It's only 0.2%. It's only a 0.2% position across our firm because it's only a $11.8 million Canadian market cap company. This target has enormous potential to grow. They just need to go out and drill it, and we'll be excited to see them doing that. But the trench samples that they just the grades in those trenches that they just put out are pretty strong indication that there's something more going on here. Let's go on to the next. It's an overview of the project with some bullet points by Bill here. They've done. Let's see. Anyway, the gold and silver mineralization outcrops on this property, so they're able to do the trenching to confirm some of the historic results. This is an open pit, oxide gold target, gold and silver, and this company just needs to get out there and drill, and this is why we put money. They also have a big gold target in British Columbia that they own, I believe, 100%, and another project in BC as well. But this is the project we want to see them focus on, and why we put the money into this company and are willing to put more when they get ready to go drilling. Let's go on to the next. Snowline Gold has had a lot of great information recently out on their new drill program and some of their new targets. Of course, Snowline has been an enormous success for Crescat, and you can see that it's only 0.13% of our firm NAV. Yes, Snowline is a company that we have been trimming based upon our geologic estimates of the amount of gold that is here. We came in early in this company. We got in pre-IPO. It's now a 2.7 billion Canadian market cap company, and that's an example of what can be done when you come into a company with only a 20 or 30 million or even less market cap, and get them the money to do that first greenfield drilling on a great exploration target. That's what Snowline had. That's why we're not afraid to invest in exploration. But the profits we've been able to take out of Snowline based upon trimming our position over time has allowed us to invest in the early stage in all these other great projects that have delivered all these great returns to our funds and to Crescat's clients, whether it's Tectonic or Sitka or BCM or Kingfisher and on and on. But Snowline was a home run. It was a home run for Crescat and in our funds, and it allowed us to continue to do what we do. Now, if Snowline can show, let's go on to the next, that some of its other targets in their area, in their of the ground that they hold are also, additional Snowline plus like targets. Maybe we'll be interested in putting more money into this company. And it's phenomenal geologic team, great CEO Scott Berdahl. But they're this is showing their ground in the Yukon of their broader Rogue project, and you can see Valley, which is where they've identified the existing resource, and they're moving it towards production, towards development, and ultimately production. You can see that Valley right in the middle is just one little piece of this bigger target area where there are multiple reduced intrusion related gold system targets. Let's go on to the next. There's a lot of slides on Valley, and Bill has followed Snowline for a long time, and he's just really impressed with what they're doing. And he's done an extensive write-up that you can review on it as well. So this is their PEA for Valley, and showing really strong economics. Let's go on to the next. This is showing what the pit is likely to look like at Valley. Let's keep going. What Bill has pointed out is there's district scale blue sky here. The company showing this in their own presentation, and they have a lot of ground up in the Yukon, and it's a great exploration team. They've just been so focused on Valley because it's a major discovery that we think will make an economic mine. They're right to focus on it, but we think there's a lot of more upside as the company does from its other projects. Let's go on to the next. One of those projects is the Gracie target, and originally this is one of the areas based upon the soil geochemistry, which you can see on the right. All those gold circles are the gold and soil results that they did from their field work, and you can see that this Gracie has a big footprint, 5.1 kilometers of potential strike length there, just based upon the gold and soils that are outcropping, and they've had some initial drill results that are not near this Gracie target, I believe, that are not unlike the initial drill results that they had at Valley when Quentin first got really excited about it, because it looked like they were on the edge of a much bigger, higher grade gold system. And anyway, I think that you're going to see more. You're going to see Snowline focusing more on this Gracie target. That'll be exciting to see. Let's go on to the next. More analysis that you can read from Bill. I didn't even do it justice. I'm not a Quentin when it comes to explaining the maps and the geology, but we have. But unfortunately, Quentin doesn't have the time to do that for us anymore. So we've got Bill. Bill is behind the scenes. He's he's not going to be on camera, but he's got 50 years of in the field geologic experience. He's a PhD, and he's recently retired from leading projects in the field. So he has an abundance of time to devote to Crescat. And so you're going to be seeing his analysis more in writing from us. I encourage you to go back and review these slides. We'll post them on our website. I don't think I have any more slides, or do I, Trevor? That's it. Okay, so we have a big treat for you. Lars, who's our PhD biochemist that has been an advisor to Crescat, is going to become a portfolio manager here with Crescat. He'll become a full-time employee in the coming months when we launch the Crescat Biotech Fund. And so Lars is going to be giving you an overview of how we invest in biotechnology. The biotech portfolio has been a small allocation, but it's been a sleeve of our Crescat Global Macro Fund and our Crescat Long Short Fund now for the past 3.5 years. It has a phenomenally good track record relative to the ETFs out there when we do the breakout of the performance there. But I'm going to turn it over now to Lars. Sit back and relax. He's got a phenomenal presentation of the Crescat Biotech strategy.
Theill. I have been advising Crescat Capital on their biotech investments for the last 3 years. I presented back in January about the prior 3 years, biotech sector, environment, and the Crescat biotech strategy and performance during that time. Today, I'll focus on 2026. We will discuss the macro and regulatory environment as it pertains to the sector. We'll briefly review the Crescat's biotech strategy again, and then I'll pepper it with examples, actually holdings or trades that we have been involved with that illustrates part of the strategy. Then we'll cover a new therapeutic modality, cell therapy, that recently were approved by the FDA, the first cell therapy to treat serious human disease was approved, and it opens up a new powerful way of treating disease. And we have a couple of investments in that space. So those are, and then we'll go over the performance of Crescat's biotech investments in 2026 so far. First, let's just recapitulate why biotech can be a particular interesting investment sector. One thing that I really like about it personally is that you are literally contributing in turning scientific discoveries into important human therapeutics for serious diseases. It's interesting also from that it's a mix of a non-growth, so a non-cyclical and a growth sector. It's a non-cyclical in the sense that there's of course always a great need for human therapeutics. And it's a growth sector because globally, certainly in the Western world, but globally, there's an aging population with larger needs for health care. The world's population is also getting richer. Tens of millions of people, hundreds of millions of people are entering into the middle class where they can afford modern health care. So it's a growth sector in that way by the increased demand globally. And it is also a growth sector because of the innovation cycle. We had an inflection point where scientific medical discovery and computational capabilities, AI, is coming together to literally exponentially increase the knowledge, scientific knowledge about molecular mechanisms of diseases, and that allows identification of the right targets to go after in a given disease. And not only that, there's also an increasing toolbox of therapeutic modalities. It used to be just a small molecule drugs, but then came therapeutic antibodies. Those therapeutic antibodies now comes in different variations. Now you have bispecific antibodies. You can go after 2 targets in combination with one therapy, or you can load them up with radio ligands, so you can create a magic bullet where the antibody can go and recognize a tumor antigen, and at the same time it brings a radioisotope with it so that you can get radiation treatment of the tumor without damaging normal tissue, and the antibody can find the tumor wherever it hides in the body. And today we'll talk in particular about cell therapy, so an off-the-shelf cell line that can be used directly to treat patients for an array of different diseases. Other modalities, of course, is gene therapy, messenger RNA technologies, and so forth. So altogether, it creates tremendous growth in the development of new therapeutics. So it's a good sector to be in from that perspective. It's also generally obtaining more support from the regulatory environment. So the FDA, there are a number of changes there that makes it easier to get drugs approved, especially for rare diseases. So diseases where the demand was not traditionally big enough that it would be viable to develop a therapeutic. It can better be done now. One change that was made recently was that now you only need to have one phase 3, one pivotal trial in order to get a drug approved. Previously, it used to be 2. Also, the increased possibilities of accelerated approval, where you, based on more preliminary data, can get a drug approved. If you, at the same time, in parallel, then runs a confirmatory trial that might read out a couple of years later. So you ultimately will know for sure how well the drug works. But in the meantime, it can be made available to patients years earlier. And also it can help drive the growth of and survival of the biotech company that is developing it while it does this confirmatory trial. Biotech is also interesting from investment because of the therapeutic super cycles. So one we're in right now is metabolic disease, weight loss drugs, ways to treat obesity with these GLP-1 drugs. So it's sort of a tsunami in that space right now. And that will continue. Currently, more advanced weight loss drugs are being developed. For instance, there's a focus now on develop therapies that can specifically help you lose fat, but preserve muscle. Another interesting part about biotech is that for the informed investors, it's really possible to a certain degree predict, or at least with, I mean, you can't know for sure, but you can get pretty good odds for whether a given investment is going to pay off or not. So, for instance, you have a phase 3 clinical trial, and if you really know the environment around that whole therapy and the disease and what has been done before and what the competition is doing and so forth, and the earlier clinical trial data with that the drug candidate, you can come up with a reasonable prediction or reasonably odds for knowing or be right about whether or not this phase 3 trial is going to work out and whether this drug is going to be approved. And if you get it right, there can be a tremendous upside in a short time. And at the same time, if you are an informed investor, you have a chance to either not pursue that opportunity or get out in time before a binary outcome if you feel that it's going to turn out negative. this is a skyrocketing valuation potential if you really know the field. There's of course a tremendous risk also. If you get it wrong, you can literally, your investment could drop 80% overnight. So it is important, of course, to apply proper risk management and portfolio diversification, and not put all your eggs in one basket, but have a broad portfolio. So let's just briefly recapitulate Crescat's bio-investment strategy. We're very much focused on late-stage clinical and early-stage commercial biotechs, which either already have approval of first-in-class, best-in-class therapeutics that addresses a significant unmet medical need in a reasonable large patient population, or the company already has promising phase 2 data or phase 3 data that would suggest that they could get to the finish line with such a new therapeutic. So that's the space we are mainly in, and that is because you can have a really good reset of valuation of these types of companies based on specific events. So if you play it right, you can have quite a gain in a relatively short period of time. It of course requires a rigorous due diligence. You have to know the company inside and out. You have to know the therapeutic modality. You have to know the disease indication and the market. You need to understand the management and their expertise. You have to understand the competition. Is this opportunity really going to be first or best in class, or are they going to be overridden by competing products, or are they even going to make it to the finish line? We're focused again on real unmet medical need. We're not so much interested in Me Too drugs. We're really seeking opportunities for something that's best in class, first in class. And it's typically in inflammatory autoimmune diseases, oncology, also neurological diseases. There's a real breakthrough in that area now, finally. Also metabolic disorders, again, we're in the weight loss drug space also. Again, risk management, position sizing is important. Have a broad portfolio, typically around 30 different names. It could be even more, but then the position sizing is very important. Already commercial companies tend to have a larger percentage of the portfolio. Both overall, the commercial part of the portfolio is bigger than the developmental stage. The position size for an individual company can be bigger if it's in the commercial and less risky space. We use a network of experts in the field, so we try to really get opinions from many different sides around an opportunity. As I mentioned earlier, we are focused on the exponential stages of the biotech cycle, in particular, looking at the opportunities around can already be phase 2 clinical trials if there's already some intermediate data that suggests that here's really something significant that looks to work, even if it's a relatively small data set. If the therapeutic effect is strong enough that you can sort of conclude that this could not happen by chance, then we are willing to look at a phase 2 opportunity. Typically, it's more a situation where you already have strong phase 2 data. There's a phase 3 trial going on, and then we try to look for a good entry point during the phase 3 trial, somewhat toward the end, but still before everybody's attention is starting to focus on the outcome of this phase 3 clinical trial, and then position ourselves there. So in that space, we try to avoid holding a position during the sometimes 2 to 3 years. That's the period between phase 2 outcome and phase 3 outcome. Typically, that period is also time named the Valley of Death, where the company is spending a lot of money, but you don't really have a lot of catalyst to the new data coming out. So that can be a tricky period. So we try to avoid that space. Sometimes we'll participate in a bio run-up, as it's called, in the immediate months, several months before a phase 3 trial data comes out, and we might, in some cases, exit or partially exit before the actual outcome. And we'll come back to talk more about why that is. At any event, often, the trial could fail for one thing, but oftentimes, even if the trial outcome is successful, there could have been an overinvestment. There are too many eyes looking at these opportunities and being excited about a good outcome. And then once it's out, then oftentimes the stock price suffers for a considerable amount of time until the product is actually approved and on the market. There's also the question of, okay, a drug is approved, but it's not necessarily then the case that the drug will be successful in the marketplace. Many therapies that are approved for one reason or another doesn't succeed in the market. Of course, there's also the possibility, we were talking about the phase 3 outcomes. Even with a seemingly good phase 3 outcome, it doesn't necessarily guarantee that the product will be approved by the FDA. It could be that the FDA finds issues that are not apparent to the outside observer, and could have reasons to not approve a given therapy. So there are these different stages in the biotech cycle, and we try to play the ones where there could be the most exponential outcome if you time it right and if you're correct in your expectation. Next slide, please. So here's a recent example of phase 3 outcome. It was Capricorn. And here we're getting into talking a bit about cell therapy as a new therapeutic modality. Capricorn had developed a stromal cell therapy. It's actually from it's a primary cells. It's from donors. You can then purify these stromal cells, expand them in culture, and then purify them and inject them into patients. It's an allogenic treatment, meaning that these cells are not recognized as foreign, even if you are injecting them into another person than the person from which the cells originated. So that's called allogeneic. So that's a tremendous advantage because the therapy will not cause an immune response in the patient. And it's also an off-the-shelf therapy. So the company can make huge amounts of these cells, and they can be stored for quite some time and be available immediately and shipped and used as therapies in patients who needs it. So Capricorn has developed that. The way these cells function is that they are anti-inflammatory. They secrete anti-inflammatory cytokines. They typically aggregate in inflamed tissue or tissue that's undergoing tissue degeneration. In addition to the direct anti-inflammatory effects, they can also help regenerate the damaged tissue. So in general, these types of cells, by virtue of these properties, anti-inflammatory and help tissue regeneration, can be used in inflammatory autoimmune diseases or other indications where you have tissue degeneration and inflammation. Capricorn is using that to treat the Duchenne's muscular dystrophy patients. These patients, it's a genetic disease, so it's called DMD for Duchenne's muscular dystrophy. The patients lack a protein called dystrophin that's required for correct structure of muscle cells in particular. So when that protein is not there, then the muscle cells are more fragile, are more prone to disruption, and that sort of creates inflammation and tissue degeneration, and you sort of get an amplified damage from immune cells coming in and destroying more muscle cells. So there they found that these cells could be therapeutic in that setting. And they showed phase 1, phase 2, and early phase 3 clinical data that showed that muscle degeneration, skeletal muscle degeneration that occurs in DMD was halted. Also, they saw a therapeutic effect in the heart. There's also, the heart is very much a muscle, the heart muscle, and you get damage there also in DMD patients. And this therapy helped the heart also to keep functioning. They had first a phase 3 clinical trial data, and they tried to get it approved by the FDA, but it was turned down. The FDA said that they needed to see results from a bigger phase 3 trial that was all ongoing already. So toward the end of last year, they were getting phase 3 clinical data from the larger trial. At that point, there was quite a skepticism about whether the treatment really worked. And the stock kept falling, as you can see in the stock chart to the right. Some investor firms sent out short reports. A lot of smart people on Wall Street, or supposedly smart people, were short the stock, and it went down to $5 or so. But then the data actually came out, and the stock then, that was the HOPE-3 data, and overnight, basically, because the data were positive, the stock price went up fourfold or so. So it went up in the high 20s. And we had looked at this opportunity during the latter part of last year, and we had concluded that these cells really work, not only because of Capricorn's own data, but also there's another company, Mesoblast, which we'll be talking about also, that had a similar cell line that also showed the same anti-inflammatory and regenerative effects in a different indication. So that gave us confidence that this new treatment really works. So we invested and ignored the short reports and did very well with that. The treatment is still not approved because they got the final phase 3 data that the FDA had asked about, and then they were given a PDUFA date, which is 6 months further out. The FDA will actually review the opportunity and decide whether to approve the therapy. That date will be in August this year. We are still holding some Capricorn because we so far see it as a likelihood that the therapy will be approved. So I mentioned that the company Mesoblast has a similar cell line, also of a stromal origin, that they have developed for treatment of graft versus host disease in children. And they actually got that treatment approved at the end of 2024. And then during 2025, they started to treat the patients, and it's going pretty well. They have now sold for more than $100 million of the therapy, and it will increase going forward. That was a part of what gave us confidence also in Capricorn. So this treatment is approved for graft versus host disease already in children, and they're now in late stage trials in adult graft versus host patients, and it will probably be approved there also. But it's only one indication. Mesoblast is also going into Duchenne's muscular dystrophy. So they will actually be ultimately probably be a competitor to Capricorn. However, they're just starting their phase 3 clinical trial now, so it will be several years before they can be on the market in that indication. More importantly for Mesoblast is that they are in phase 3 already in really large diseases. One of them is lower back pain. And lower back pain is a tremendous unmet medical need affecting tens of millions of Americans and, of course, hundreds of millions of people around the world. And today there's really no solid treatment for lower back pain. The only treatment that works somehow is steroids, and that's again the diseases we have been talking about before, which was DMD and the graft versus host disease. Those diseases were typically treated with steroids, and the steroids works well for a few months, but then or maybe half a year or so, but then the therapeutic effect sort of goes away or diminishes, and at the same time, the longer you are on steroids, the more risk you are for developing very severe side effects. So there's one of the big areas of therapeutic development now is to come up with treatments that can supplant the need for using steroids. And we're talking about very, very large diseases and very broad spectrum of diseases. It might be even fair to say that almost a majority of human chronic diseases are caused by some type of inflammation, autoimmunity, that causes tissue degeneration and pain. And all of them can be treated with some success with steroids, but again, only for a period of time. So there's a huge drive to come up with treatments that can be as effective or more effective and work long term without side effects. Stromal cell therapy seems to be one effective way of doing it. So Mesoblast is not only in lower back pain, but also in inflammatory heart disease, which also is a tremendous opportunity. And again, they're also in phase 3 in that indication. We have recently got involved with Mesoblast as an investment. It's somewhat early days, but we think that there could be some real opportunity there long term. If you look at the stock chart down to the right, you can see that it has been a very long journey. The company has literally been trying to develop this therapy for since the early 2000s. There have been in a number of pivotal trials before that ultimately failed, and it has to do with that therapy was not fully developed. What they've done over the years is now optimizing the correct way of mass produce these cells and purify them, and also to treat the right way. And again, they got a drug approved a year ago, doing well in the market. You can see that stock price is starting to respond. It was down at maybe a couple of dollars in 2023, and now it's about 15, so it's probably up tenfold during that time. But it could have significantly further to go over time. This is not sort of an immediate opportunity, but just an example of a company that's already commercial, which has a therapy that's basically a portfolio drug. You can use the same cells, the same therapy in a whole range of different diseases. At least that's the potential and the prospect. This slide speaks to what we could call the holy grail in investment, at least one of them. I think it's Warren Buffett who coined this phrase first when he asked about how to be successful in investment. He said something like, you have to be ready to be fearful when others are greedy, and greedy when others are fearful. And of course, we can all appreciate that, yes, that would probably be a great way to make money. The problem is, how do you turn that into practice? It relates, for instance, to that we are humans. You know, we have a tendency to follow the crowd, and if everybody else is cheerful and greedy, think something is a great opportunity, then we are likely to think it also. And the same thing if everybody is running away from something, and it could be an investment, then our nature is to do the same. So you sort of have to try to operate in a very different way that's counter-human to really apply what Warren Buffett is suggesting. But first of all, this is a figure from a financial research paper published last year, and it looks at the small biotech, and it looks at what happens after a binary event like a phase 3 outcome, depending on whether the outcome is positive or negative. if we start on the positive side, phase 3 trial, the data are great. Then, of course, the stock price goes up some degree. You can see that with a stippled curve. It goes up about 10% here when they're looking at about 20 different events like that, and looking at what happens on average to the stock price after this outcome. And of course, if it's a good outcome, the stock price goes up. But curiously enough, if you look out about 100 days later, then on average, the stock price will have fallen back to below where it was before the data of the trial came out. So that can sort of suggest that too much exuberance comes into play when there are good news. Too many investors pile in. After a while, they leave again, and the stock price could be lower than it was before you knew the outcome of the trial. Conversely, if the outcome of the trial is negative, then yes, that's expected. There's a dramatic drop in the stock price, on average about 50%, if we are talking about a small biotech company. But then the curious thing is that if you look out 100 days later, then the stock price on average will have increased by 50%. So that suggests that this is a capitulation after a negative event. Everybody sells, everybody leaves the building, and the value of the company is sort of at a rock bottom. Everybody who considers selling has already sold. Whoever is holding the stock now might be because they have special insight or other reasons. So the value at that point can potentially be a good entry point. There, of course, it requires that you do some serious due diligence and to find out whether there's really value left. And more often than not, there is. So it's worth to try to pick the right failures. And again, even on average, even if you invested in any of these events, on average, the stock price could go up 150% in 100 days. Of course, not all of them will do that, and there'll be several situations where the company will, and its share price will continue to suffer. But statistically, it's a good space to be in, to this notion of being fearful when others are greedy and greedy when others are fearful. This provides scientific evidence that there's something to it, that you have to be careful on good news. There's also actually the adage on Wall Street of sell on the news. So which literally suggests that, okay, once the good news are out, it might be a time to sell. So it's really worth paying attention to. And that's also why sometimes we decide to exit an investment maybe a short time before a binary outcome, like a phase 3 result or a drug approval decision. The good potential news might already, for the most part, be baked in, and there might be more risk to the downside than upside. This kind of analysis sort of helps you in a way to try to do the right thing that Buffett suggested to, and especially for biotech. I mean, there's this significant potential upside if you are able to pick the right losers. So that's an important part of our strategy also. So here's an example of a company whose stock price fluctuated wildly over a relatively short period of time based on exuberance and fear. The company is Biotech. They were developing a very promising therapy for advanced malignant melanoma. And you can see that up to during 2025, the stock goes from 1 to more than 2, and that's on expectation on hopefully a positive outcome from a pivotal phase 3 trial they were running. Then the results come out, and the data showed that they missed by a hair on the pivotal endpoint. So the data was not quite as good as hoped for, and that caused the stock to be cut in half, more than half in value, back to 1. Once you looked into the data a bit further, it turned out that there was a very large pre-specified subgroup of patients that did tremendously well on the treatment, and that then caused the stock price to go back up to 2. And then that was in the anticipation that now the company would go in front of the FDA and see if the FDA would be willing to consider approving this drug. They then met with the FDA and got a negative verdict from the FDA. The FDA basically told them to run a whole new trial, and that caused the stock price to then fall down to about 50 cents. But then because the data was really good in that subgroup, this anticipation that somehow the FDA would be able to be persuaded to maybe give accelerated approval or something. So the stock went up to more than $1 again. And probably it would have been the right thing to do for the FDA, but they didn't do that. And then the company eventually faltered, also because they didn't have the best senior management. And now the company is basically going out of business. But that was just one example of how fear and exuberance can play out dramatically in small biotech, and you have to be careful how you navigate that. But you can also see that even though this investment ultimately did not pan out, along the way there were at least 2 times where the stock price in short order more than doubled. There's actually 3 times within about 6 months where the stock price literally doubled. So there can be temporary opportunities within an otherwise bleak scenario in biotech. A very recent prominent example of how you can have overreaction to the downside in small biotech on a negative event. In this case, it's actually an PDUFA event, so it was not the outcome of a phase 3, but a sort of similar situation. You had a PDUFA date with the FDA for potential approval of a new drug. In this case, a therapy called RP1 for treatment of advanced melanoma. Yeah, let me just give a brief background that RP1 is an oncolytic therapy that is given in combination with checkpoint inhibitors like Keytruda, so anti-PD-1 treatment. And it was given to patients who had failed on checkpoint inhibitors in advanced metastatic melanoma. Those patients don't have many options, viable options left. So the idea there was to give an oncolytic virus that would be able to go in and break up the tumor, also expose the tumor antigens that could then educate the immune system to come in and fight the tumor, and do that in the presence of checkpoint inhibitors that would take the brake off the immune system, and together you could have a combination effect that would restart and invigorate the immune system's attack on the tumor. And the company had actually shown very good clinical data, very good phase 3 data, where these patients who otherwise have really no options, 32% of them had a partial response. A good number of them had a complete response, and it was very long-term, durable response. The patients, the oncologists, and so forth, very excited about the treatment. The problem with the treatment was that they did not have a real placebo control arm, and the reason for that is that that would have required that you gave half of the patients, or at least a third of the patients, anti-PD-1, which they had already failed on, and there would be no chance that they would benefit from it. So that's why that arm was not there, and the company thought that the FDA had agreed to that if the data were strong enough, then the FDA would consider approving it, or at least give it accelerated approval without that control arm. Nevertheless, the FDA decided that they were not going to approve it, and that caused a dramatic fall in the stock price. So it fell in the short time from $8 and down to $1.50. At that around that time, we had evaluated this company. It's called Replimune, and some of you might have read about it in the news, or might even be following it yourself. But we went in and looked at the whole pipeline and concluded that it seems like this oncolytic treatment really works, not only in melanoma, but also in a range of other serious cancers, including pancreatic cancer. I mean, we don't know for sure whether it will work ultimately and be approved, but we thought that there's a really good opportunity for that. We concluded that even if this drug ended up not being ultimately approved in melanoma, the value of the pipeline was such that it would be worth investing in the stock at those prices anyway. So we entered into this opportunity at $2, and here about 3 weeks later, the stock actually today, Wednesday, closed at $3.47. So it has had quite a run up in the last 3 weeks. That sort of exemplifies what I was talking about, that there's oftentimes an overshoot to the downside. In this case, it might also be the the increase in the stock price over the last couple of weeks might also be related to things that are playing out in the news. So again, most of the key opinion leaders, the people participating, the oncologists participating in the clinical trials, running the trials, and the patients advocate groups, and the industry groups, they were all surprised and dismayed that this treatment was not approved. So there have been several editorials in the Wall Street Journal. There have been pieces in Scientific America, in cancer newsletters that are widely read on Capitol Hill, on Bloomberg, where this situation is being discussed. That is probably also part of the reason why we see this comeback in the stock price. It's still a fluid situation. We don't know what is going to happen with the company. Certainly not what will happen with the melanoma, and they are running trials in pancreatic cancers and other indications. It will be some time before that plays out. The company have had to cut half their workforce to trim costs. So it's a fluid situation. So far, we have a good gain in a short time. To be honest, we sold part of the position today just for prudent risk management and to log in some profits. We're keeping part of the position, and we're not quite decided what to do with it. But I brought this up as an example again of how in the small biotech things overshoot to the downside on bad news, and it can create some short-term investment opportunities. Okay, so let's turn to the bigger picture about what is happening in the biotech sector in 2026. And let's start by this slide, which bullet points are taken from Morgan Stanley, something they published early on in the year. And the idea they are promoting is that the stars are aligned for small and mid-cap biotech in 2026. They point to increased deal making, merger and acquisition relating to the pharmaceutical industry. Big Pharma is facing a patent cliff in the coming years, and they're getting increasingly busy trying to replenish their pipeline, in part by acquiring smaller biotechs with already proven new therapeutics or therapeutic candidates that are perceived to be just on the cusp of being approved and with a chance to develop into blockbuster drugs. So that's a tailwind for 2026. They point out that the commercial companies are doing very well already and are sitting on a lot of cash. So it also gives these companies opportunities to go out and acquire other players, smaller players. They also point out that during periods of 2025, there was a fear that with the new administration that has come in early 25, changes to the FDA and also drug policies, how to pay for drugs and so on, drug prices, that there would be a negative impact on the industry there. But now a year forward into beginning of 2026, the general perception is that there's probably not that much to fear from the FDA. If anything, there have actually been some good initiatives within the FDA that could benefit drug discovery. We mentioned earlier that for rare diseases, you only need one clinical phase 3 rather than 2, an increased chance of accelerated approval and so forth. So that's a positive environment also. Morgan Stanley is also calculating that these small to mid-cap biotech companies are projected to have 14% revenue year-over-year growth for the foreseeable future. Revenues in that sector growing from 57 billion in 25 to more than 100 billion by 2030. So significant growth in the commercial smaller and mid-cap biotechs. Here in 2026, we're also seeing that most of the biotech companies that are still in business are of a much higher quality than what was seen in prior years. During COVID, there was this exuberance about biotech saving the world. So a lot of money was pouring into small biotechs, a lot of IPOs and so forth. So a number of companies were started and received a lot of money basically on some science project rather than more hardcore clinical data or further along opportunities. There's been this consolidation in the industry after from 21 and up to 25, a lot of these companies eventually failed. And the crop of biotech companies that we have now is really high quality. Many of them benefited from this tremendous influx of money some years ago, and that allowed them to develop pipelines that are now at a late stage. So the whole quality of the biotech sector is much more attractive now than it was 2 or 3 years ago. The backdrop for these companies, and here of course we are particularly talking about these high-tech, high-quality companies with late-stage assets, strong balance sheets. They have cash enough to make it to the finish line, whether that's a drug approval, launching a product, or at least getting some very important phase 3 results. These first-in-class, best-in-class therapeutic candidates, and with in a real unmet medical need with a big enough market, so there's a clear commercialization path. So for these types of companies, whether they are a young commercial or late stage development, there are some really good there are good opportunities there, and they are in a good environment to be successful, in part because of this merger and acquisition. We talked about some of them might literally be bought out, and I'll show you that that's already happening in a minute. It's also a better environment now for IPOs and secondary offering. The companies are still sensitive to interest rates and FDA regulatory uncertainty. The FDA issue we talked briefly about the Replimune. So it has been and continues to be an issue that the FDA is a little bit of a revolving door of different new people coming in, and it seems to affect the policies in some cases where it's more unpredictable how the FDA is going to treat a given opportunity. So that's of course a headwind, but on balance, they're also making a lot of improvements that makes it easier to get drugs approved in other areas. So on balance, the FDA environment is probably a positive one and a tailwind. And interest rates, they are a bit smaller than lower than they were at times last year. At least it seems to be somewhat stable. So it's a good overall good macro environment for biotech now also. Next slide. Merger and acquisition, I mentioned, is really picking up. Here's a list published by Reuters just a few days ago that lists about 10 different merger and acquisitions or big pharma deals that has occurred just over the last few months. One of them is Day One Biopharmaceuticals, which we actually happen to be involved in at the time of acquisition. Next slide. has entered into an investment in Day One Biopharmaceuticals late last year because they had a good drug approved for low-grade glioma in children, and it's a main type of brain cancer in children. And so they sort of owned that space, seemed to have a successful launch. So that's why we entered. We thought that they could do well on their own. They also had a nice pipeline of other drugs. Within a few months, the company literally got bought out at a significant premium, 80 or 90% over the stock price at the time. So we were fortunate to participate in that. And of course, it's a main focus in our strategy to be involved in other similar companies that has a product that could be attractive for larger players and for potential acquisition candidates. These positive developments that we see in biotech in 2026 started already in the spring of last year. So literally about a year ago, when biotech had otherwise hit the rock bottom. It was sort of the final capitulation after the excesses after COVID, where the Wall Street were disappointed for a couple of years because all the money they had put in, there's not a reasonable return on that. By the time of early spring last year, most people had basically given up on biotech, and biotech had sort of been the area you go into if you want to make money shorting a company. So it's sort of gotten to the point, again, back to what we were talking about earlier, where everybody was extremely fearful about biotech. So almost everybody had either exited or were directly short the sector or many companies in the sector. And that, again, worked out for some time, but everything comes to an end, and so did the exhaustion with biotech. It was so undervalued that smart investors then started to pile in last spring, and the rest of 2025 was very positive. You can see that the sector, from underperforming the S&P 500, which is in blue on this graph, then caught up by the end of summer, and then went on to outperform through the end of the year. And of the two major biotech funds we're looking at here, in yellow is XBI, which is an equal weighted index, which has higher presentation of the smaller companies. And then the IBB, which is just the sector overall. So there's a higher representation of larger cap biotechs in red. And you can see that the smaller companies were outperforming the larger biotech companies. So that went on all of last year. And the smaller companies are continuing to outperform the market in 2026, whereas the more established, the larger companies are just keeping up with the S&P 500. But overall, you can see that this positive trend, especially for small biotech, is continuing to some degree into 2026.
All right. So that's Lars, who will be the portfolio manager for the upcoming Crescat Biotech Fund. He's been behind the scenes as the analyst for that sleeve of our global macro and precious metals funds. And you can see the carve out performance, the extracted performance that we were showing there, and really nicely outperforming the the benchmarks. And so we're excited for the opportunity here. The whole reason we got into biotech in the first place is because we believe it was a deeply undervalued situation post COVID, and it's really only been in the last year that the opportunity has really come to life, and we think there's a lot more upside ahead and a lot of alpha that we can continue to generate from the strategy, especially with Lars at the full helm here as portfolio manager. So stay tuned for more announcements regarding that. And I'm going to end it. This has been a long one. They will not be this long in the future, but we appreciate all of you for sticking around for this episode. And
NVR announces.
Please feel free to reach out to Merrick if you have any interest in our strategies, any questions. Contact information is right here, and we'll see you in 2 weeks.
Thanks. Wrapping things up here for the weekend.